Today, we're diving into sweeps and ranges, two of the most powerful concepts in trading. Sweeps are incredibly effective trade triggers, whilst understanding ranges is essential since markets are often range-bound. This video is packed with insights that will transform your trading strategy. But stay tuned until the end, as every detail is crucial for mastering these concepts and applying them successfully in your trades. So let's get into it. Your trading game is about to get a serious upgrade. We're going to start this video by looking at sweeps, but first let's talk about order types. There are two categories of orders: limit and market. Market orders are instant, whereas you need to wait for price to hit limit orders to fill them. Okay, so market orders sound great, but they come with their disadvantages. For small market participants, the only disadvantage of using market orders is the taker fee. This is the trading fee you pay when using a market order. But for larger participants, it's both the taker fee and slippage. Let's explain slippage in simple terms. There are two people trying to buy an asset, a little guy and a big guy. The little guy wants 1 unit of this asset and the big guy wants 10 units of this asset. The market is trading at $100 and there is 1 unit available at each single dollar price point. One at 100, one at 101, one at 102, etc. If the little guy wants to buy his unit, this is easy. He just takes the unit available at $100. But when the big guy wants to buy his 10 units, he's going to have to take every unit from 100 to 109. This means that although they both wanted to buy at the same time, the little guy has an entry of 100 and the big guy has an average entry of 104.5. Now, this isn't a very good way of doing things for the big guy, and the reason is because there aren't many units available. So, what does he do? Well, he looks to operate in areas where there are more units available, or in other words, more liquidity. Okay, so let's put a pin in this big guy's problem for now. We will come back to him, but first we need to talk about stop losses. Stop losses are orders in market form that are executed as the opposite of the position. If you're long, you need to sell your position to get out of it, and if you're short, you need to buy your position to get out of it. Stop losses are placed at points of invalidation, which means where you're wrong on the trade. The eye and mind are naturally drawn to key highs and lows on the chart, and as a result, this is where most are placed with a rationale of I'm short and wrong above this high, or I'm long and wrong below this low. Subsequently, these points on the chart tend to build up a lot of stops, or in other words, liquidity. Additionally, we have breakout traders. These are traders that are looking to take trades in the direction of the trend. These breakout trades are often taken at key highs or key lows, looking to play the trade further in the direction of the impulse. So let's put this all in motion. Let's say we are trading at $110. There's a key low beneath us at $101. We have 5 traders that are long here with their stop losses just below the low of 101 at 100. Remember the big guy? Well, he sees this low and places his limit buy or bid at 100 for the 10 units he's been after, waiting patiently, or in some cases encouraging price to move down to his price in order to get his fill. One way or another, price comes down and stops out all of the little guys, meaning 5 market sells occur, and at the same time, 5 breakout traders also try their hand at a short, all with 1 unit each, also in market form. So we have 5 stop losses that have occurred from the longs that have lost their trades, and we have 5 breakout traders hitting short at the same time, all trades made with 1 unit, meaning 10 units of sell-side liquidity are now available at this price. These are then absorbed by the big guy's limit bid for 100 units, and just like that, he's got his fill at $100 without any slippage. At this point, the selling that was going to occur in the market has occurred, and as demand for the market now outweighs the supply, the market then pushes back up. What's left in the chart in visual form is a candle that traveled past the key low at 101, reverses at 100, forms a lower wick and closes at 102 before reversing to the upside. This is what's known as a sweep, otherwise known as a type of failed break, liquidity hunt, stop run, or swing failure pattern. Now, let's take a look at how we mark these targets. First off, we have to always bear in mind that we are looking for key highs and lows. That means only marking highs or lows in relative isolation that really stand out to your eye. For instance, we can mark levels like this, simply doing so with the horizontal ray tool with the magnet activated for ease. But we would not be looking to mark levels such as these, as they are not key highs or lows in isolation, but instead just random points within price action. Now it's time to move on to our next concept, ranges. So what is a range? Put simply, it's a period of sideways price action as opposed to a trending market with clear directional intent. And that's really as simple as it is. When marking your range, you should have 3 points to be aware of: the high, the low, and the middle of the range, like so. The best way to draw your ranges is creating a custom extended fib tool. If you don't know how to do this, please watch the support and resistance video where I cover this in detail. The only changes you'll need to make are adding an additional level in here for our mid-range, and once you have this up and running, you can drag and drop and mark out your ranges. When it comes to how to mark your range, textbooks will tell you to take the first swing high to the first swing low. But personally, I like to take this with a pinch of salt and draw it how it best fits the chart. Always taking the outer extremities being the wicks as opposed to the bodies of the candle. In terms of using ranges for execution, the rule of thumb is that we don't take trades in the middle of the range, which is why some traders say never diddle in the middle. Trades should only be taken at the extremes, being the range high or range low, and generally we want to trade the range from high to low and low to high until we get a sustained breakout of the range. In other words, play it until it breaks. Well done for getting this far. I hope you now feel like you're understanding the concepts and know how to mark your levels to work with. So today we've covered sweeps and ranges, and you're probably wondering what the two have in common. Well, the range highs and lows we've just looked at are in fact also key highs and key lows. So there are some overlaps in how we can play these concepts. When price breaches or starts going past the range highs or lows, there are two plays that can occur: a breakout or a failed break. A failed break can occur in two visual forms: a sweep, as we already know about, and a deviation. Whereas sweeps are sharper attacks to the range highs or lows where we see price wick past the levels and close back above or below it, deviations are slower concepts where price actually closes outside of the range. From here, price can hang around for some time before eventually closing back within the range and starting its trajectory towards the other side. Remember when we spoke about how sweeps are usually a combination of stops hitting and breakout traders piling in? Well, deviations are similar, however we often see more breakout traders attempt their shot at playing continuation as price hangs around past the range extremity longer and gives more time and confidence to do so, especially as in these moments price usually looks like it will continue in its direction. At this point in the video, it would be good to touch on our old friend, context, especially pro-trend versus counter-trend trades. Sweeps and deviations are great tools to use when trading with the trend. For instance, when we see an impulse into the creation of the range, price to start ranging, a sweep or deviation of the range, and continuation. These plays are great trend joining tools and something I recommend placing good focus on. You can of course take these plays counter trend, but I'd advise you to focus on sticking to the pro trend side of things until you have many notches on your belt and feel like you're willing to be a bit more daring. Of course, there may be no trend present, particularly in the case of ranges, as by the very nature of the concept, this is also how price behaves when there is no trend in play. When in these environments, you can approach your trades with zero directional bias and play these failed break patterns, whether sweeps or deviations of the range extremities, back and forth until they stop working. So how can we action what we've learned in terms of execution? Well, the conventional method of execution when playing a sweep or deviation is simply waiting for price to close back within the range on the time frame you've marked the range and using this as your trigger. For instance, if you've drawn a 4-hour range, textbook theory would say to wait for a 4-hour close back within the range to confirm the failed break, and not just jumping the gun when you see the 1-minute close, as this won't have high enough validity. That being said, you can play around with installments such as taking 25% on a 30-minute close, 25% on an hourly close, and the remaining 50% on the 4-hour close. This way, you'll be entering in a slightly more risky manner, but will also be tightening up your overall R on the trade. This is all well and good, but I'm sure you're thinking, once price breaches these levels, there are two outcomes: the failed break or, of course, a breakout. Well, worry not, as I'm going to teach you how to figure this all out. But in order to do so, we'll need to understand another vital trading concept. And this concept, my friends, is speed.